To be honest, for our region, the Middle East, it was pretty well telegraphed. From a financial markets perspective and from an investor perspective, most of the countries where there is a significant amount of financial exposure or investor interest are seeing the kind of the lower end of the tariff scale around 10%, with some exceptions, but mostly the likes of Egypt, the likes of the GCC countries, those that have significant financial engagement in international capital markets are all on the lower side. It's not really the direct impact of tariffs, I think, that are likely to have an impact here. It's more the indirect impacts via global trade, via oil prices, and via the financial channel. What happens in the rates markets for rates and the impact on financing prospects in the region. I think that's where the focus is more for investors in this region.
And just going into that a little bit more, which countries would be most at risk or most vulnerable now?
Well, clearly, the impact on oil prices is a concern in the longer term. Now, in the near term, as Sri was talking earlier, you have the concerns around secondary sanctions on Russian oil exports that are putting upward pressure on oil prices. But generally, the longer term view, and certainly our view, is that there is downward pressure or downside risk to oil prices coming from the introduction of tariffs, from the slowdown in global economic growth relative to the previous baselines and so on. And also from the supply side, which was also mentioned earlier, with OPEC Plus pumping more and more barrels onto the market. So I think that's clearly the number one concern for the GCC countries. From a financing perspective, I would highlight Egypt as being a country which so far is doing absolutely fine in terms of its external financing and attracting a lot of international capital. But clearly the volatility in core rates is not something that serves countries with large external financing requirements well. Saudi Arabia is also another country which, while oil prices are where they are, is fine from an external financing perspective, but going forward may need to borrow more international markets if oil prices come down. And that's something that'll be more expensive in an environment where oil rates are more volatile.